Chris Hoy, ODI. I just had a question about the fact that a lot of the time foreign investment in developing countries would maybe benefit development more if there was a stronger labour-intensive side to the sort of labour capital mix of production. But a lot of the time they use technology that was developed in the developed world, which had a particular slant towards capital-intensive sort of development and manufacturing industry, etc. So I was wondering, how do you reconcile the use of capital-intensive technology in labour-abundant markets, and the role of the private sector and potential government regulation in assisting in that?
Thank you. This is one here.
Hi, my name is Mark Boland. I work for a US research consultancy called IHS. So my question is primarily directed to Matt, and it involves the private sector in this sort of recipient country. How do you view the two cases or extreme cases where you have an established private sector, like for instance in Kenya with the insurance industry, which on one hand might mean that your potential clients are actually familiar with the product and the business model, your business model when you're trying to establish. But on the other hand, maybe most of the more attractive clients are already tied up with these established companies, especially in your industry where a lot is about relationships. And also maybe the potential of establishing a joint venture with a domestic actor in the market, and the difficulties if you're establishing a joint venture with what I would guess would probably be a sort of for-profit company, and trying to bring in a kind of a development perspective, and how do you combine those two so different models?
Thanks. And there was one right here.
Thank you. Kamlesh Jadeja from Crown Agents. It's just a question around the potential debt burden which could be faced. I know we're in the City of London. There is ingenious amounts of innovation in terms of financial products and private finance which could be offered, especially in infrastructure. Sometimes it's very hard to trace the steps and actually follow the chain, and we've witnessed that. That's what we've learnt. And I was just wondering, how, or what do you think the best way is of trying to push, what is a voluntary code, the Equator Principles, into these sorts of deals, and maybe moving it forward into something much more structured and something which can be looked at, which can be understood even, because I think maybe the financial knowledge that we think we have, that donors have, multilateral development banks have, probably isn't as great as we think it should be, what it should be.
Okay, thank you. And one right here.
I'm John Burton from KPMG. I have a question for Matt, really, about this. You mentioned this number, $3 to $5 trillion, which is a big number to finance SDGs, and the private sector is sort of thought as of a solution because the public sector doesn't have that sort of money. And you made the point that actually it's about the private sector's core business, because you're not going to get that sort of money from corporate social responsibility initiatives, which I think is true. But isn't there a big distribution problem in that kind of thinking, in that the private sector isn't necessarily interested in the people and the areas of the world where the development problems are going to focus? And if you go along with that line of thinking, then you start saying, well, what are the solutions that are going to change the way the private sector is operating? And I just wonder, isn't the big contribution of the private sector not really in its money, but in its ability to develop new ideas, to innovate and provide technology? So that was one question. And then another question for Meenakshi was, from the perspective of DFID, is it possible to quantify the benefits of your new approach compared to other things that DFID would traditionally do. Is it going to be cost effective as a way of, reducing poverty as compared to putting people through school or health intervention? It's a very difficult thing to quantify, but could help your case if you could show that this actually is delivering much more per pound of aid money.
Thanks. Let me, Matt, maybe we could start. There's, I think, a general and a specific for you. So that was the general question about the role of private sector in development. There's also a specific question on the potential role for joint ventures in the insurance sector.
All right, maybe I'd take them in reverse order. I think the starting point is there's a line somewhere for the private sector. If people don't have disposable income, then it doesn't really matter what sector you're talking about. There's not much the private sector can do. And so for the most hardest to reach, the extreme poor, I don't think that the private sector has a huge role to play in poverty alleviation at that stage. However, it doesn't require a large amount of disposable income for all of a sudden the private sector to be able to contribute in some way. And I'll give you an example. Our business in Ghana, about a third of our premiums are distributed through mobile phones. We have a partnership with a local mobile phone operator. And some of these premiums are being collected from people who aren't earning much more than a couple of dollars a day, and they're paying through the deduction of airtime, and it can be 5-10 cents a month that they're paying in premium, but they are buying insurance. They're becoming financially included. We are making not really making much of a profit, but we're covering our costs doing that business, and that's an example of innovation, finding a way to facilitate to make people who aren't earning a lot of money, to provide them with products which are valuable to them, but on purely commercial terms. And so I think actually you don't have to get very far above the bottom of the pyramid to get to a stage where if people have money to spend, the private sector as a whole is pretty innovative and will find ways to provide people with the goods and services that are valuable to them, and they may look very different from the way the nature and the distribution channel of goods and services in other countries, but I don't think the capacity to innovate in the private sector is as strong in Africa as it is in North America. There's no limit to what can be done if the customers have a little bit of disposable income that they can afford to set aside. In terms of when we look at markets, I should say again the broader point is that we don't really look at what a market is today, because when we enter a market, it may take us 5, 10, 15 years to build a business that's really of scale. We don't make any stuff. We're not selling phones or shoes or anything like that. And so when you start an insurance business, it can take 5, 10, 15 years to build a book of business that's mature. And so really the question we're asking ourselves when we enter a market in Ghana or Kenya or whatever is, what will the market look like in 10 or 15 years' time? And so the nature of competition and the structure of the market today doesn't really matter that much. We're not going there to steal customers, if you like, off the existing companies. Where the penetration in Kenya, although they've got a robust insurance industry, is only about 1%. So it's more about how do we work together to grow the industry and bring more people to be aware of insurance. There's more than enough customers to go around, and that will increase as the middle class grows. And so there's not it's not a question of a zero-sum game and fighting over individual customers. It's about bringing the market to more customers, particularly in countries with young populations. The number of potential customers will grow more or less exponentially over the next 10 or 15 years.
Matt, can I just ask you a follow-up question to that? If you look at when you mentioned the growth of your operations in Southeast Asia,
yeah,
And in a lot of those markets where you're a very significant player, Prudential is one of the biggest purchasers of government bonds and equity stocks to underwrite local currency risk. I mean, to what extent is that a constraint in Africa, the thinness of equity markets and government bond?
In the end, insurance is an inherently mutual concept. We just facilitate customers pooling either their risk or their savings, and so in the end it goes back to what customers get out of it. And it's true that long-term investment options that we're able to provide our customers in some markets aren't as good as they are in other markets. It's the thinness of equity markets. I'm not entirely convinced that customers who have a lot to lose should be investing their savings in equities anyway. But one of the issues is the availability of long-dated government bonds. So, one of the advantages of us as an industry is if you buy a 20-year savings product from us and you change your mind after 3 years, you can't have your money back. And that enables us to buy 20-year government bonds because we have illiquid liabilities. And so, for instance, in Vietnam, we were in a situation 10 or 15 years ago where we were going to the government and saying, can you issue some long-dated debt so that we can buy it? You might not need the money, but it would be a good thing for your economy if we had some way to put this money that we've been promised, and then you could think of things to do with it. And so it is very important, but it's kind of, sometimes it's a bit of a vicious circle. There's no long-dated capital because there isn't a demand for long-dated capital, and there's no demand for long-dated capital because there's nothing to invest it in. So.
Okay, thanks. Magdalene, do you want to maybe take the question that was raised on debt? I mean, it's a broader question, but I guess one of the issues that's come up a lot in the context of discussions on Ghana recently is that the country's gone back to bond markets to refinance debt, and at relatively high interest. I mean, 8% interest, and I guess the key question is, are these hard currency flows going to go into activities that generate the returns that will prevent this from becoming a potential debt problem?
Yeah, thank you very much. I think, first of all, the bond that was raised recently, about 250 million of it is going into our infrastructure financing investment fund, and that is supposed to finance commercially viable projects. So that's one of the ways we want to use that money. Some of it is also going to finance domestic funds or debt already raised. And it's good to know that it's actually cheaper than what we raise on the domestic market. Because of the relatively high interest rate on the market, the government finds this relatively cheaper. That is why we are raising it. Again, it's also to finance part of the old bond that was actually raised some time back. So that is also going into that one. However, as much as possible, we realize that some of the innovative ways I mentioned is the issue of our SOEs, where we realize that they are actually causing most of the debts, that we have, in terms of the fact that we have borrowed, a lot of loans have been borrowed for the water sector and for the energy sector, for which government is directly servicing. And this places a lot of burden on government financing. And therefore, the innovative way we put in was to restructure some of these entities, the SOEs, as I had mentioned earlier on, and also for them to actually start servicing these facilities themselves, because we realized that if they became more responsible, then they would be eager to actually ensure that they get the returns that they are supposed to get from the projects that they undertake from these enterprises. In terms of other innovative ways, I think in London is very different from Ghana, and at times you find it very difficult to replicate what happens here directly to what happens in Ghana. And therefore, I believe that with time, we will find a way of actually improvising certain ways to ensure that we can keep our debt sustainability at bay. But I think these are the things that we have done to ensure that at least we become stable in terms of our debt sustainability over a period of time. And we are willing to, take in more suggestions from various entities.
Thank you. Stephanie.
On specific point that you have just raised. I think with Dirk, we've thought a lot about this. I think it's very tricky to actually refinance domestic debt for foreign debt, which looks cheaper, but is not necessarily cheaper, because domestic debt is in your local currency, and so, okay, the interest rate is higher, but then you have to take account of the variation of the exchange rate. And for example, Ghana is actually a good case. The cedi has been depreciating on average about, I think, 7%. So then you have to add that to your cost of borrowing. Secondly, if there is a big shock, for hopefully not, it can be a major devaluation, and then the local debtor, either the government or the banks, could be in a lot of trouble. I mean, just to give you one really bad example, Hungarian households borrowed for their houses in Swiss francs. And they said, oh, isn't this nice? We're paying like 1% or something. And of course, then the Swiss franc went up and the Hungarian florin went down. And it's a complete disaster, yeah? It's part of the Eurozone crisis. So you have to really think very carefully about this. Should I take some of the other points or quickly? Or
You could. I wanted to put one question to you, which those of us who are non-expert find something of a mystery, in which Ghana is an example, that you have an economy that's growing at 7% a year that can't or doesn't borrow from the IBRD. Which potentially lends at 2 to 3% at the moment, and instead goes to bond markets at 8%. I mean, does that say something worrying about the financial architecture for development financing?
Yeah, and also is to add to your argument, the term, the maturity at which the World Bank would lend would be much longer. So I think it says something about the conditionality and the hassle of borrowing from the World Bank that we should think about, because it may actually, in the long term, be much better to borrow from institutions like the World Bank or the African Development Bank. I think a loan takes about 2 years on average, at least in Latin America, to borrow from these multilaterals. And, if you're in fashion, I'm sure the bankers or the investors will give you a loan in 1 month. So it's very it's much more attractive for a government who has to deliver to borrow from the markets in the short term. But in the long term, I think you're absolutely right. But you should maybe answer that as well. I wanted just also to say on this issue of innovation that the Crown Agent colleague mentioned, if I may. I think one of the things that I find is that we need less financial engineers in the city and more real engineers, because we need financial products that actually help finance, specific things in infrastructure, which tends to be, I think the principles are actually quite simple, and there is an opaqueness and a complexity which is partly oriented to make people not understand what the risks are. And I think it's very important that we encourage but also regulate institutions in the city to be very transparent and to do certain products which are helpful. For example, this idea of capturing the upside. So you have equity forms where you take, you can take a loss if the project goes bad. But then if the project goes very well, like this case of Google, for example, the US government didn't get any money back. And people like Mariana Mazzucato complain that on top of that they don't even pay tax. So how can you deliver these kind of financial engineering tools, but that serve development rather than the other way around? And what role can bilaterals, development banks, and others play to promote these kind of more simple but more effective financial tools?
Thank you. Meenakshi, could I ask you to maybe take two of the issues that came up? One question on the labour intensity of capital investment, which was a feature of the project that you described, but in a broader context seems to be an issue. And the second one, actually from a colleague from KPMG, on the demonstrability of results, because this is clearly more complex than let's say delivering mosquito nets or whatever. So.
Okay, so on the labor intensity, I think we find that companies do adapt. So banks which have ATM counters here in just like a little window, in India they will need to have a little room with a guard sitting outside. I mean, that's it. It's, you have to adapt. I think if you could simply take your production model from an international setting to labor abundant country which didn't need labor, why would you do it? I mean, you wouldn't shift that production model anyway. You would only move if you needed labor. So I think that's the way I see it. On the question on results, yeah, we are quantifying benefits. So what we are doing is we are actually monetizing benefits. So we are looking at benefits as either increase in income or cost saving to people. And we are projecting them, getting a present value. And in fact, not only that, we are also linking our partners' financial incentives to those development benefits. So our partner gets a share in the profit, partly based on the profit that they make, but partly based on the development results that they generate through the investments that they make. So I think we've come up with a neat idea, but it's only now being put into practice and getting tested. I think eventually, irrespective of how much that adds up to in present value terms, we will never stop doing balanced development work. So, women's rights can't be delivered through this, for instance. Ebola crisis needs public capacity and, macroeconomic policy. I mean, there are just too many roles that specific constituencies have to play in the development field for us to use something like monetized results to swing the balance too much in favor of anyone. I would say that actually the private sector can play a role in every development goal that we have, including those who are below poverty line or very poor, extreme poor. And the reason is because even the public sector needs to buy private goods and services to deliver goods and services to the poorest of the poor. So to take an example, food supplements are getting distributed to millions of people in India or in anywhere else, but a clever person comes up with an IT system that helps you track exactly where it is and tackle corruption. So you can use that particular private good to tackle that problem. There are mobile apps that are getting developed which women vegetable vendors who can't read and write can use to calculate how much profit they're making in a day simply by using some codes on, because now they have mobile phones. Even poor people have mobile phones. So I'm just saying, be imaginative. There are roles that private sector can play in almost any problem that we have, but let's not be swinging too much, saying only public sector or only private sector in any of these. Well, yeah, that's the point.
Thank you. Let's take another round of questions. One right here in the front. Is there a microphone?
Just go ahead.
I think the microphone is about to arrive right here.
Yeah. Thank you. Yeah. Thanks very much. Edward Pace, Africa Research Institute. Can I just pick up again on this issue of currency risk and sovereign bonds, please? I think this recent report, I think it was an IMF report in the last within the last 6 weeks, showed that only one of the African sovereign bond issues since 2007, I think it was a Côte d'Ivoire issue, had ended up cheaper than going to the local bond markets because of the currency depreciation over the period. So this is just bearing out what you're saying. My question, perhaps, is that economists in Zambia at the moment are fairly taxed about the the debt management capacity within the financial system. So, in other words, the capacity to make these judgments when the sovereign goes to the bond market in this way. I mean, Nigeria's debt management office, pretty sophisticated and so forth, as is generally known. But there are countries coming to the markets with arguably inadequate capacity to be able to judge all the risks and to be able to run the relevant scenarios over the period of the bond. What can be done to support the building of debt management offices throughout Africa, but also throughout developing countries in general?
Thanks, Edward. One right at the back.
Thanks very much, Jonathan Glennie. Yeah, I had a question about maybe some of the politics of this, and we've heard the. It's been a very interesting panel, by the way. I've learned a lot, and someone mentioned the term conditionality. I think it was Stephanie, and I wonder what the panel think about what kind of probably indirect conditionality will come with an increase in private investment. Because we've spent 20, 30, 40 years dealing with the problems of the conditions attached to international public investment. And it seems to have improved somewhat politically. So, I mean, especially I'm interested in for Matt, you presumably have meetings with, you said you have meetings with governments. Presumably there are certain policies that are useful for your business, and presumably you push for those. And so to Magdalene, how do you deal with that kind of pressure, which is just natural in a way, but also could be counter to some of your policy positions? Let's take, for instance, and Matt's talked about it, health investment, health insurance. It seems to me quite logical that in the short term, some kind of health insurance, and Matt talked about very poor people putting money forward. That might be necessary given the current situation. But maybe in the long term, you want to see a universal health coverage, such as we have in Britain, whereby that basically isn't required. That might go counter to the interests of an increasingly large prudential in that country. So just those kind of issues. I wonder if you can discuss those, because it's definitely not just about money here. The arrival of private investment, big time, in some poor countries will have serious political repercussions.
Okay, I've got two questions here and one there that I'm going to throw back to the panel. And this.
Great. Mine, very quick to follow up on Johnny's points. My name is Ruth Kelly. I work for ActionAid. In terms of the PPP bill in Ghana, kind of following up on that point, what kind of risks have you been looking at in that bill? Just interested to hear more.
Thank you.
Alistair McKechnie, I'd like to link up with a discussion yesterday we had on private finance for infrastructure. And the first question is in a highly imperfect environment, what is it reasonable to expect that can be done? I mean, when utility prices, electricity prices are below cost, as they've been in many countries the last 60 years, the business environment is imperfect, and even if there are laws in place, the justice system may not be reliable to enforce them. And I was involved with the private power crisis in Pakistan, and there was essentially no redress the investors had. There were no assets abroad that could be seized. And another point I'd like to make is, and this is more for the insurance and pension funds, one of the issues with infrastructure finance is matching the terms of the finance with the economic lives of the assets, which are very long. And when we talk about climate finance, it's essentially a capital for energy substitution. So what are the impediments to getting long-term finance from insurance companies, from pension funds, and other ways in which the risks can be pulled cross countries, through some sort of securitization, for example? And my last question is probably to Magdalena, is on how to award these PPP concessions. I mean, if someone comes along with an idea which may be innovative, negotiating which may not be terribly transparent compared to, in Bangladesh they went out to bid on the price per electricity and they came out with PPPs that had a lower cost than public sector options. So what's the best way for a country to award these PPP concessions?
Okay, and then there's one question right here that I'm going to pass it back to the panel.
Thank you. I'm Carolina Renteria from the World Bank, and I come from Colombia. And first I want to say to Professor Stephanie that I really like what you say, because I think it's so nice and important to have like a reality check I think that sometimes we are in this like hyper emotional world in which things are going to change, and I think Africa has a lot to learn from Latin America that went through the 4 decades of strengthening, went through a debt crisis, had the market closed. There's a whole history there that I think is worthwhile looking at. And I think part of what I was thinking before this panel is that we had not talked much about macroeconomic conditions in countries in a debate that deals with international finance and how to finance the Millennium Development Goals or the SDGs or any investment program in any country. So I think there's always this need to continue thinking that macro is important, and in that part, I think there's a role for international support in strengthening ministries of finance, as was mentioned here, not only for debt management, but for the whole need to have strong institutions setting that understands and can deliver in macro terms. So I think that I really like that, because if not, it's kind of a disconnect between at least what we have experienced in Latin America. And the second comment I want to make is in terms of private sector. I think there are many roles the private sector can have, but I think one that we usually don't mention openly is behave properly in terms of paying taxes as they should pay, not look, for example, for tax havens or other options, because internal revenue mobilization means taxes, and taxes mean from private sector. So what is the role of private sector, for example, in that, in allowing countries to tax the private sector? Or the other one is, for example, don't taking advantage through PPP contracts. I mean, Colombia has went through a crisis after crisis of PPP contracts that ended up being so costly. And at the end, it would have been much cheaper to build the road with public sector than just using the PPP option. Thank you.
Thanks, Carolina. And also thanks for reminding us about realism and avoiding hyper-emotionality just before lunch. We certainly don't want to go down that road. I think this is really getting us into some of the politics behind the discussion in a number of areas. So, that we've got one set of questions about the, I guess to put it crudely, the risks of a new HIPC type debt crisis, and do we have the debt management capabilities in place to avoid that sort of outcome, given the strong return to sovereign bond markets and private capital flows across Africa. I think there are then really two sets of political questions. One is around what Jonathan Glennie described as a conditionality or implicit conditionality, which I guess can come partly through bilateral or regional investment treaties, can come partly through the rules of the World Trade Organization, through individual investment deals, but I guess for any government there is that challenge. To what extent are the government's priorities threatened or enhanced by the terms that it has to comply with to attract foreign investment? And then there was another set of questions really about the politics of PPP. That this is clearly it's often presented as a sort of technical type of issue. We have an infrastructure financing gap here. We need to find the incentives to bring the resources in. But bubbling beneath the surface, there's often some pretty tough politics that goes on in areas that Stephanie described. The investors looking to maximise the rate of return, governments looking to share risk more equitably, and ensure that investment goes into government priority areas. So what I would ask each of you to do, I know it's a tall order, but maybe if you could respond broadly to whatever of that menu of issues you want to take up, and also give us a short closing remark before lunch. And I know that's a tough order, but the clock is ticking.
Thank you. Well, to start with the specific, obviously we're a regulated business wherever we operate in the world. We talk to governments and we lobby governments to share with them the things that we think are important. I think of the lobbying or conversations that I'm having with governments in Africa at the moment, they're exclusively around regulations that would make the industry bigger. And so whether it's about opening up different ways of selling insurance, removing restrictions on certain types of product, there's nothing about getting tax breaks or talking about visas or anything structural like that. It's just purely at the industry level. And the important thing I think to state here is that governments are sophisticated organisations. The regulators understand their industries perfectly well, and sometimes they find what we're asking for in their interests and they say yes, and sometimes they say no, and they always have the right, whether it's in the UK, Indonesia or Ghana, to say yes and then a few years later change their mind and change the regulation. So it's always a robust debate between equals, if you like, about what makes sense for both parties, and the regulator always has the upper hand because they can always change the rules, and we have to live with them. In terms of capital more generally, I don't want to get into politics, but I think all of the conversations that we've had stress the importance of countries developing sources of domestic capital, so they can borrow from their own citizens, the insurance industry, like the pension fund industry, is one example of that. And that really is the most sustainable form of capital for investment. A couple of things that I wanted to comment on. In terms of the returns that private companies demand, just a technical point, the way that investors evaluate the attractiveness of a project is what's the return you expect above the local sovereign rate. And so at the moment in the US, sovereign bonds are yielding 2%, and in Ghana it's 12-13%. And so you will not put your money into Ghana for 15% if you can make 8% in the US. It's not emotional, it's just mechanical. And so, we're at a particularly unusual time in the global economy, in that sovereign bonds in developed markets are yielding very, very low amounts of money, and not for good reasons, for bad reasons. And so that's doing that. And there was one more point I was going to make. Maybe there isn't.
Okay.
I'll leave it at that.
Magdalena.
Yeah, thank you very much. I think on the issues of debt management, I think we have quite a capable debt management division that looks at the various risks involved in all these processes. And they took a very good decision in going for the bond. I know there are several issues surrounding the currency risk, the foreign exchange risk, but I think these have been well analyzed before going into the bond. Again, in terms of our health policy, we have a national health policy that actually has a national health insurance that everybody pays. So I believe that is for the very low, level poor people who would want to pay that on a very regular basis, maybe little by little. And I think they've done well in ensuring that such an innovative process is in place. In terms of our PPP bill, the PPP bill itself does not talk about individual risks as such. It talks about global risks. But what we try to do is in every project, we identify the specific risks in every project and ensure that we go through a thorough and a rigorous project preparation process by getting a transaction advisor, which is clearly spelled in our policy that if you want to undertake a project, you need a transaction advisor who would advise you on all the various risks, the technical, the financial, and all the issues that pertain to a particular project, in ensuring that the project at the end of the day becomes bankable. So that the risk profile is looked at specifically on a project-by-project basis. And in that process, the entity that is capable to actually mitigate that risk is then requested to mitigate that risk. In terms of how do we provide, give concessions, award concessions in PPPs, especially when there are innovative projects that are brought by the private sector. Our first point of call in terms of guiding principles for PPP is to ensure that there's transparency and there's competition. And on top of it all, we want to ensure that we have value for money for the projects that we undertake. We do not want to encourage private sector entities bringing in their own projects, because first of all, we want all the projects to be in priority projects for government. And we are trying to encourage all the MDAs to bring their prioritized projects, and then we assist them to prepare these projects, to put them out there for the market and get the private sector entities to competitively bid for these projects. However, we also do not want to kill private sector initiative. And therefore, if there was an innovative project that would come on board, we would adequately review that project, get a transaction advisor to actually go through the project, effectively analyzing all the technical and the financial issues that have been raised in the project. And again, we would also put it out there for other private sector entities to bid on the project. And if possible, if we think that we have better value for money from another project sponsor, we would discuss with the initial project sponsor and then have come into a conclusion for the initial project sponsor to take on board the other issues that have been raised by another entity. And if possible, and they are willing to take on the pricing, possibly maybe at a lower price with better incentives and everything, then that project sponsor will be awarded the contract. Nevertheless, I can assure you that we haven't gotten to that particular point yet. There are lots of political ramifications in some of these projects that we undertake, and at times you have political pressure insisting on giving a project to an entity. But however, we do ensure that we get a transaction advisor to review these processes and ensure that we get better value for money at the end of the day. In terms of, I think, my own conclusions, I think we welcome private sector entities into Ghana, but would require as much as possible to ensure that the various risks are shared effectively. The private sector entity takes on the risks that they can best mitigate, and the public sector would assist as much as possible to provide the support that is necessary and is required. Thank you very much.
Thanks, Magdalena.
Yeah, I think we should avoid too much hype around any one solution. And when we do that, that's when people start accepting unreasonable. Of course, there could be corruption issues and so on and so forth. But I think one is, of course, I feel that the predominant expectation here seems to be private sector is equal to FDI is equal to large. That's not the case. And I think what I take away is that one is don't forget SMEs, don't forget indigenous and local, and in no policy or strategy should we have which biases it too much in favor of one or the other, and they all have roles to play. So I think they provide the checks and balances that we need. Otherwise we become too dependent on that single investment that's going to change our world, and that's not the right way to look at it.
Thanks, Meenakshi. Stephanie, last word to you.
Yeah, thank you. I think your last point was excellent about the benefits of kind of having, for example, a diversified financial system, both domestic and international. I think domestically, for example, public development banks went completely out of fashion, partly because of the World Bank, which is itself a public development bank, telling a lot of countries to close them down. And I think that you need precisely, as you say, a diversified system, domestically and internationally, where you have, for example, large and small banks, private and public banks, cooperative banks, and so on. And an example, I think, I don't want to idealize it, is the German financial system, which has all these different parts and which seems to deliver better for the real economy. My second point is this issue of giving credit like to SMEs or pooling risks, I think may require help. And for example, you can think of ways of, if you have a lot of projects on, say, energy efficiency, you can pool them together, maybe securitize them in a simple way, and then sell them to big institutional investors. This has been done quite successfully, say in Europe, but it can be done also in developing countries. But finally, I want to talk about the issue of power, because it's true. I think governments are very capable, and when I listen to you, I feel much better about how things are being done in Ghana, because you clearly thought through all the issues, including of selectivity of foreign investment, which I think is important. I mean, you can also tell the companies, we want you to use more labor-intensive technologies because we have a problem of unemployment. But recently, not many governments dare do that, but they can. But there are, I think, certain asymmetries of power between big banks, big investors, both direct and institutional. And I think one of the role of public institutions like the FID or the World Bank can be also to help developing countries, not just in technical terms, of course this is important, but also in strengthening their bargaining position, I think, with big banks, with big institutional investors, to help them ensure that they get good deals. And a final point, I think, on Jonathan and Colombian lady, is the point about conditionality. It's sort of ex ante and ex post. I mean, in macro private flows terms, with private flows you have no conditionality up front, but you have the risk that if you have a crisis, it's going to be worse, because the IMF and so on, World Bank will come in when you're really without money, and then, of course, they will impose tougher conditionalities. Whereas maybe if you negotiate a preventive loan with the IMF or a lot of money from the World Bank, you will have a lot of hassle initially, but you won't have this very tough conditionality at the end. And I mean, I think you have to be cautious about how much, for example, you fund government debt foreign. The Japanese, and I'm not giving them as a model because they have debt to GDP ratio of about 200%. But they have not had a debt crisis. Why? Because they pay for all these bonds and they fund them all domestically through like saving banks and stuff like that. So maybe we have to think a little bit more about that.
Okay, so thank you. Let me first ask just to thank all of our speakers for what were really fantastic presentations. So and you'll be delighted to know I'm not going to try and summarise that session, especially just before lunch. But I do think that in the discussion we got behind some of the financial flow issues, into some of the politics and power relationships and underlying difficulties of operating in markets. So thank you to each of you. I think arrangements for lunch are that we just step outside of the door and eat. So step outside the door, turn right, start eating, and be back at 1:30. So thank you to everyone.